Superannuation is once again getting some big changes. In just the last week, Australia's Treasurer Jim Chalmers announced a raft of new changes to Division 296, and it stands to have a big impact on your retirement, particularly if you're a self-funded retiree. So in this video, I'll take you through what is just announced and how it will affect you going forward. Yes, it's back. Division 296 is set to be legislated with massive effects for those with over $3 million per person in their superannuation fund, and particularly those with over $10 million in their super fund. But more on this will be coming later in this video. Before we get started, I just want to do a recap on superannuation, why it is such a popular and why it's such an important part of any self-funded retiree's retirement and investment strategy, and how this new cap or limit or additional tax will apply to those balances. So firstly, we have to remember what superannuation is. Again, there's a general feeling with people that I meet that superannuation isn't their money. Superannuation is founded in 1992, and it is basically you being forced to delay your spending to help self-fund your retirement so the government doesn't have to. Now, there are three types of superannuation fund that we talk about in Australia as an advisor, and these are industry super funds or union aligned or profit for member as they're called now, self-managed super funds and corporate super funds or platforms as a side option of that as well. The tax that we're talking about, the Division 296 tax, will apply regardless of which type of super fund you have. Just to reiterate, what are the benefits of superannuation and why is it such a big part of any financial advice and retirement planning strategy when it comes to investments? It's because once you commence a pension from your superannuation balance, which you can do from 60 if you leave work or leave one of your positions or retire, or from 65 with very few conditions or no conditions at all the income, so that being the interest, dividends, realized capital gains tax, all those things are tax-free. Similarly, once you turn 60, all the benefits you take out of superannuation for the vast majority of people are completely tax-free as well. Now, applying caps to superannuation is not new. It's actually been subject to caps for close to a decade now, and it's already subject to two important caps. That is the transfer balance cap. This has recently increased to $2 million, and that's the maximum you can have in that tax-exempt or tax-free pension phase. And also the $2 million total super balance cap, which controls whether you can make further non-concessional, so that being after-tax contributions, not super guarantee or your salary sacrifice contributions. And both these caps are set at $2 million. Similarly, there are two phases of superannuation you need to know about when it comes to your savings and how the tax will apply. The first is accumulation. We can also call this savings mode, where you're still saving, you're still working, and you're earning an income and you're not relying on your superannuation to supplement or provide all of that retirement income. Generally, you can't access your super yet, so if you're under 60, or in some cases you are over 60 or over 65 and you don't need to. In accumulation or savings phase, you pay 15% tax on the earnings in your fund, including realized capital gains, interest, and dividends. So that's much lower than the vast majority of marginal tax rates that are available, and better than investing via a company, which is a significantly higher tax rate. Similarly, you actually get a discount on realized capital gains if you've held those assets for 12 months. So if you're held in your own name, you get a 50% discount on your marginal tax rate. But in this case, in superannuation, you get a 1/3 discount on the capital gains that are realized, which means you're paying a tax rate of 10% on the realized capital gain. The second phase we need to talk about is pension phase. This is when you've met a condition of release. That could be you've turned 60 and you've stopped working, or lost a job, or had multiple jobs and left one of those jobs, or it could be you just turned 65 and that's all you need to do. Once you meet one of these conditions of release, you can convert your superannuation balance into a regular income stream to either supplement or take over your work income or your salary that you were receiving before. But in return for commencing the pension and to get those tax exemptions that we've talked about, you have to draw a legislated minimum that starts at 4% for those under 65, increased to 5% for those between 65 and 74, and continues to increase before it hits 14% for those in their late 90s. You are also limited to starting pension at a maximum of $2 million, which is that transfer balance cap we talked about before. But interestingly, this $2 million is index and will increase with inflation, not every single year, but in larger increments as the cost of living or as inflation continues to increase. Similarly, if your earnings take you over the $2 million cap, you don't have to take that additional over the $2 million out. You're able to keep that in pension phase. So what is the Division 296 change that has been proposed in October 2025 and set to apply from next year? Well, originally it was as follows. If you had a balance over $3 million, the portion of your balance, regardless of what super fund, and this is on a per person, not a per fund basis. So if you've got a super fund with over $3 million, but it's with two people and neither of those people are over $3 million, it doesn't apply. But the portion of your balance over $3 million would have had all the earnings tax at a larger amount. So an additional 15% tax. If you think about it, the percentage of your fund over the cap, so if the balance of your fund is $4 million and you're $1 million over the cap, then 25% of the earnings of your fund will be taxed at that additional 15% tax rate. Noting that you're already, in most cases, paying that 15% tax on the portion of your super fund that was already in accumulation phase. So if you had $3 million, and keep things simple, $2 million of that was in pension phase, earnings on $1 million worth would have been taxed at 15%, and this added an additional tax on 25% of those earnings. What was the problem? And there was a lot of media coverage, a lot of political pressure, a lot of articles, and a lot of lobbying by a large number of groups, was that the biggest problem was that the $3 million cap wasn't indexed to inflation. That means it didn't increase like almost every other superannuation and related cap when it comes to tax. It also meant that hundreds of thousands of people starting their super journey today would be captured in the future, which, as our understanding, wasn't the intention of the legislation, but perhaps it was. So this was a massive challenge. It also intended to tax people on unrealized capital gains. That is, the increase in the value of your shares or property or any other asset, crypto, gold, before you even sold it. That would be a first in Australia and incredibly rare around the world. For instance, if you own an investment property and the value of that property went up from $1 million to $1.1 million, then the following year you have to lodge a tax return, you have to get a valuation, and you're going to pay your marginal tax rate on that $100,000 gain. That's what they were trying to do to superannuation. Luckily, for the time being anyway, been thrown out. The big question now is, what is the change? So first, the introduction of Division 296 has been delayed until 1 July 2026. It was intended to start 1 July 2025, but as in most cases, it was never passed through Parliament in time. This is a year later than it was originally proposed. The tax rate of 30% will still be applied on balances over $3 million. So again, we have to be clear here. It's not a tax rate of 30%. It's an additional tax of 15% on the proportion of the balance of your superannuation fund that exceeds $3 million and only applied to the earnings. Another tax will also apply to balances over $10 million, being a top up to 40% net tax on the proportion over $10 million. So that's an additional 10% on top of the also additional 15%. Most importantly, the $3 million cap will now be indexed to CPI in the same way as a transfer balance cap. So applause to the government for coming to the party on this one. The $10 million cap will also be indexed, which I think is incredibly important. But most importantly of all, it won't apply to unrealized capital gains. It will only apply to assets that you sell in any given year. So the craziest part of this policy is gone, thankfully, rather than inadvertently picking up hundreds of thousands of people in the next few decades. The focus is very much on the ultra high net worth individuals, those with in excess of $10 million in their super fund, and those using superannuation as a transfer of wealth vehicle as opposed to a vehicle to provide a retirement income. According to the government, they estimate that 90,000 people will be hit by the $3 million cap or the $3 million tax, and only 8,000 people by the $10 million tax as it currently stands. This will obviously change over time, and it will also open opportunities for this to be adjusted and amended in future years. What is incredibly interesting is that in the announcement about this, the government confirmed that they still haven't worked out exactly how it will apply to themselves. That is, how this will apply fairly to defined benefit. But they have said it will apply commensurately to defined benefits. They're just unable to confirm exactly how that will work. Now, if we could work through an example here, and bear with me as we go through this, but let's consider an example where your balance increases from $4 to $4.5 million, for instance, as an individual in a super fund. Say you're in an SMSF, but you could be in a platform or with an advisor. That's $500,000 in earnings. Of the $4.5 million, $2 million is in pension phase, and $2 million was in accumulation phase. So you would have paid tax at 15% on 50%, that being the $2 million in accumulation phase of the $500,000 in earnings that you received. So 15% tax on $250,000 equals $37,500 in tax. In addition to this, from 1 July 2026, 33% of your super fund is now over the $3 million cap. So $4.5 million balance, $1.5 million over the $3 million cap, which means 1/3. That means 33% or 1/3 of the $500,000 of earnings, or $166,000, 666, will be taxed at another 15%, or $25,000. So that takes the current tax of $37,500 up to a total of $62,500 $500, not quite doubling, but a near doubling of the amount of tax you paid as a result of this legislation being introduced. Again, thankfully, this doesn't apply to unrealised capital gains anymore, which will make it significantly more simple to report to and abide by, and it won't apply to as many people as in the past. Now, if you're concerned about your superannuation balance, if you're in this window of $3 to $10 million or a self-funded retiree looking for advice, please reach out. And as always, please don't react and make changes based solely on announcements, and ensure that these are in place and passed as they are before making adjustments to your strategy.